Hi there. As you can see, CVS has declined by more than 16% in just one day. They reported the results for the first quarter of 2024. And because they missed the analyst estimates, they reported lower earnings than expected, and also they lowered their guidance. The stock price has declined by more than 16%. And pre-market, the stock price is expected to be about $56. So as you can see at the current level, this company is paying a nice dividend, almost 5%, 4.7%, and the P ratio is about 9.8. Now, if you look at the analyst estimates, what they expect in the future for CVS, you can see that the revenue is expected to grow a lot, and also the earnings and free cash flow. And if you try to value this business based on what the market expects, you can see that the great scenario, the fair value may be over $90 per share. And now the stock price is about $56. So you have a margin of safety at the current level based on the analyst estimates, what the market expects. Plus, besides this margin of safety, you also get a nice dividend over 4%. So while you are waiting for a rebound in the stock price, you also get a nice dividend over 4%. It's about the same as the current interest rates, which are about 5%, as you can see here. So you are protected. But of course, there is also risk with this company. That's why you have to look at the upside and the downside. What you can expect. Because as you can see, for the last 5 years, your return wouldn't be that great if you had invested back in 2019. The stock price was about $52 and now about $56. So your return would have been quite small. That's why you have to know when to buy and when to sell, especially for investors who bought this company in 2020 at the beginning of 2022 when the stock price was about $106. The return hasn't been that great, a decline of almost 50%. So you want to avoid those situations. Of course, if you had invested in 2019, you also got a dividend over or about 4% a year. So that's nice, because if you had invested that dividend when was a dip in the stock price, at the end your return would have been much higher. That's why it's quite important what price you pay. So let's start with the analysis. As you can see, for the first quarter, the revenue has increased by 3.7%. That's good. The problem is that their earnings have declined a lot. As you can see, their operating income has decreased from 3.4 billion from previous quarter 2023 Q1 to 2.2 billion. And that happened because, as you probably know, this company has three main segments: healthcare benefits, where it's more about insurance, then health services segment, and pharmacy and consumer wellness segment. So when you look at these segments, you take them one by one, you can see that for healthcare benefits, the revenue has increased a little, but here they reported the highest decline in operating income. As you can see, their income has decreased from 1.8 billion to 700 million. So they had a decline of 1 billion in this segment, healthcare benefits, because if you read more about this segment, you can see that the decline was primarily driven by increased Medicare utilization. They had more claims for patients and they had to pay them. So that's why they reported this decline in their earnings. Now for the other segments, health services, the revenue has decreased by 4 billion compared to the last year, 2023, and also their adjusted operating income has decreased by 300 million. So this is another drop in their revenue and earnings. And the last one, pharmacy and consumer wellness. This segment did well. The revenue has increased a little, and also the operating income has increased just a little by 43 million. So as you can see, they are well diversified, they have more segments, but the biggest decline was from insurance, their insurance segment. healthcare benefits. As you can see, this segment offers a full range of insured and self-insured medical, pharmacy, dental, and other products. Now, because those bad results and they lowered their guidance for the full year 2024, as you can see, the earnings per share guidance are expected to be at least $5.60, and their previous guidance was that their earnings were expected to be about $7, and also their cash flow is expected to be at least $10 billion. Be aware that cash flow from operations, not free cash flow. And their previous guidance was that they were expecting 12 billion. And that's why you have this decline. Now, when you look at the estimates, you can see that the revenue is expected to grow more in the future from 356 billion to over 467 billion. Their earnings are expected to go up, even though they might be down in 2024 to about 7 billion, but in the long term, they're expected to rebound to 12.8 billion by 2028. Also, the dividends per share are expected to increase from $2.42 to $3.12. So that's great. By 2028, you'll have a dividend about 6%. So that will be nice if they can increase the dividend even more in the future. And then you have to look at their opportunities. As you can see, CVS is a stable business. The annual growth rate for the pharmacy market is expected to grow by 3.8% from 2024 to 2028. So that's why I said it's stable. You can't expect a higher growth rate, over 10%, because as you see, the revenue for 2023 was quite high, over 356 billion. So if you expect a growth rate over 50% a year, then this is not achievable because of their huge size. Of course, they might do other acquisitions, but don't expect a high growth rate. Just stable. About 3% or 4% a year. Something like that. Now, as I said, they might do other acquisitions, they might offer other services and improve their operations so that their earnings can increase more in the future. This is the upside. And that may happen if they can handle well their operations. Now, you have to be aware of the risk. As you can see, they have some claims on their balance sheet, which are about 22 billion for pharmacy claims and healthcare costs, which are over 14 billion. And those claims, as we've seen, they have three segments, especially this segment, their insurance segment. This was down. They reported a decline in their earnings, quite high. And you have to be aware because the more claims they have and they have to pay them, the lower their earnings will be. That's why you have to be aware of their claims and of course healthcare costs. This is another risk you have to be aware. If you look at their balance sheet, you can see that healthcare costs have increased from 20 billion to over 27 billion. And these costs are likely to grow more in the future. That's why you have to be aware, because if they have more claims and higher healthcare costs, then their operating income will be lower. You will see other decreases in their earnings, as it happened in the first quarter, a decline from 3.4 billion to 2.2 billion. So you have to be aware of this risk. That their earnings, their future earnings might not be that high, what the market expects. It might be lower, less than 12 billion, maybe 10 billion. That's why you have to see all the scenarios. Try to value this business based on the analyst estimates, but also on their own estimates. So let's start with the fair value. First, the reward. As you can see, the gray scenario, if CVS delivers over 12 billion in earnings by 2028 in the next 5 years, and they also continue to do some buybacks and pay dividends, then the fair value per share may be about $90. And now the stock price is $56. So as you can see, you have a margin of safety, quite a huge margin of safety. If you like this business and you believe in its future, then you can take advantage. Now, you also have to look at the normal case. Maybe their growth rate won't be that high, their earnings may be a little bit lower, and the fair value per share may be about $7-8. So when you compare the fair value market cap with the current market cap, you can see that you still have a margin of safety for a 10% annual return. So that's great. Of course, you also have to be aware of the risk, because maybe next year their earnings may decline even more and the fair value per share may be about $65. So you have to be aware of that. And as I said, another risk is that they have some debt and also claims. And if you include their net debt and you try to revalue this business, let's say their net debt is about minus 26.98 billion, then the fair value per share is lower. As you can see, the best scenario, the fair value per share may be about $44. The great scenario, about or almost $70. So still you have a margin of safety. And the normal case, the fair value per share is about the current stock price, $56. So it's up to you how you want to value this business. You can ignore their debt, you can do that, and try to value this business only on the analyst estimates. But if you also include their debt, then the fair value per share will be much lower, about $56. But still, at the current level, you might get a 10% annual return. And that's great, especially as the stock price has declined so much. In the long term, you are likely to double your money in the next 5 to 10 years. So this may happen. Of course, you also have to take into account the risk, because maybe they'll face more problems in the future. Higher health costs, other claims, and of course competition from Amazon and other companies. And who knows what can happen. That's why you have to put in balance the risk and the reward. At the current level, it's likely that the stock price will do well in the long term. But it also depends on you. What return you want from this investment. If you are pleased with 10% annual return, then you can take advantage and invest in this company. So that's it for this video, and if you have other questions, please let me know in the comments.